Hello, this is Richard Murphy of Tax Research UK, and I want to talk about a new report that has been published in the first week of November 2009 by the Society for Trust and Estates Practitioners, a professional body based in the UK, made up largely of people who actually work in tax havens and who supply what they call wealth management services. I have another description. They're trying to hide their clients' assets from taxation around the world. Now, this report is being used by them to justify the existence of what they call international financial centres, but which I call secrecy jurisdictions, and which most people call tax havens. The report is called International Financial Centres and the World Economy, and it's by a professor of economics and law in the United States called James Hines Jr. Now, Jim Hines is well known as an economist in this area. He has a long history of publishing on taxation matters, but he is, and I would stress the point, a very conventional economist. He fits into the normal mould of economics. And some of the people who are watching this video might know that a while ago the Queen of the UK, the Queen of England, asked economists why didn't they see the recession coming? And it was a very good question, and put in a nutshell, precisely why so many of us have real doubts about economics. It asks the wrong questions, has the wrong value system, makes the wrong assumptions, and comes to the wrong conclusions. And I have to say, that's a pretty good summary of this whole report. I haven't got time to write about the report in detail. I'm going to pick up some issues within it now and explain why I think it utterly misses the point and fails to make its case. The report says a number of quite extraordinary things. For example, it claims that if a company invests in a tax haven, its sales increase. Do you know, that is a statement of the absolute bleeding obvious. If you actually look at the activity of a company that uses a tax haven, nothing ever really happens in that tax haven subsidiary company. I'll give you a simple example. Suppose a multinational corporation is going to ship goods from an African state to a European state. Now, let's be candid, in most cases that means the goods will be put on a ship in Africa and they will arrive at a port in Europe. But for transactional purposes, they decide to actually ship the paperwork from Africa to Europe via a couple of tax havens where supposedly value is added through supplying intellectual property rights, marketing services, and maybe insurance services, and heaven knows what else. Now, if the paperwork followed the goods, there'd be a bill out of Africa for, say, £100, and there would be a bill into Europe for exactly the same sum, £100. But if this paper trail does not follow the goods, it leaves Africa for, say, £60, and then arrives in the Cayman Islands where intellectual property is received, and where the billing onwards is for £70, and then arrives in the Isle of Man where the insurance services are supplied, where the billing onwards is for £80, and then moves to Jersey where the whole process is apparently subject to a management fee and is then billed on for £100, you'll see that we now have bills of 60, 70, 80 and finally £100. But the 60, the 70 and the 80, if I add those all up in my head, that's £210. Makes it appear that this whole transaction is now worth £310 in all, when only £100 of goods have ever been shipped from one to the other. Quite simply, this report has added up apples and oranges and come to a completely wrong conclusion. Of course the sales are higher. The transaction has been split into many parts. It does not mean it's worth any more. This is what happens in tax havens. You divide and you rule by splitting transactions up, and you hope that the little bits aren't noticed and tax may not be paid on the way. So that claim that there's a boost to economic activity is rubbish. The second claim is that there's more employment in companies that have tax haven subsidiaries. There's a very simple reason for that. The biggest companies have tax haven subsidiaries. They can afford to set them up, they can afford to manage them, and they have more tax to hide. There is absolutely no other explanation that is required to explain why this is the case. If you actually correlate things without seeking obvious explanations, you come up with apparent proofs which aren't proofs at all. They're simply observations of fact. Big companies have tax haven subsidiaries. End of story. Next claim is that apparently having a tax haven nearby a state increases banking competition in a major state. So, for example, banking competition would apparently be much higher in the UK because we have some adjacent tax havens, Jersey, Guernsey and the Isle of Man. Now again, this is absolutely nonsense. What the author of the report seems not to have noticed is that all the banks in Jersey, Guernsey and the Isle of Man are in fact British banks or German banks or US banks or French banks, but not one of them is a Jersey bank or a Guernsey bank or an Isle of Man bank. So this is a completely nonsensical argument. Banking is dominated by 20 banks around the world, all of which are multinational, all of which are based in developed countries, none of which are based in tax havens. They use branches in tax havens, secrecy jurisdictions, to hide transactions from view, to restructure transactions, to save tax, to facilitate their clients in saving tax. But none of that has anything to do with domestic tax competition. This is a complete nonsense because those tax haven branches are simply adjuncts to the onshore activity based in London or Frankfurt or Paris or New York. So this is a complete and utterly false argument. So what else did he have to say? Well, he said that there's great governance, good governance in tax havens. Tell that to those people who look at money, corrupt money stored in Switzerland. Switzerland is supposedly one of the cleanest states in the world. There's a remarkably low rate of corruption of local government and central government officials in Switzerland, which is the definition that is used for good governance by some people at the World Bank. Well, yeah, maybe there is very low rate of corruption inside government in Switzerland, but 1/3 of the world's dirty, stolen money is in Swiss banks. How can you say that represents good governance? The argument is completely farcical. Any state which is going to hold money on behalf of other people does, of course, have to uphold the rule of law. That is why the most stable tax havens in the world, particularly those that are supported by the British judicial system through the Privy Council, are very popular for the purposes of tax haven investment. But it doesn't mean to say that because they happen to uphold the rule of law and the right of contract, that they are actually well governed with regard to their tax haven activities. Those tax haven activities turn a complete blind eye to the abuse of law in other states. And if you want an example, I'll mention 3 letters, UBS and its activities in the USA. A well-governed bank, supposedly from Switzerland, which is supposedly well-governed, was actually undertaking criminal activity in the USA. So again, this argument falls completely flat on its face. Let's look at the next argument, that somehow or other the low tax rates which are offered within tax havens are of benefit to other countries in the world because it creates tax efficiency in governments. Now, in my opinion, government's level of spending should be determined by one thing and one thing only, and that is the ballot box of the state in which the spending is to take place. I know very well that a lot of tax havens take great offence at the idea that they should have their tax rate determined by people outside their shores. Well, I also take great offence that people like the Society for Trust and Estate Practitioners turn around and say they have the right through their activities in small states to influence the tax rate and the level of government spending in the UK. They do not. Their activity in this sense is fundamentally anti-democratic and is to be utterly and completely condemned for that reason alone. If nothing else stands up to being condemned in this report, that one certainly does. But let's summarise this whole thing. What we actually see is an economist arguing that well-being, as he defines it, that simply means stacks of pound notes moving around the world faster and faster, is increased by tax havens. He's right. Tax havens do promote vast amounts of economic activity if you measure it in terms of pound notes, yen, euros or dollars. But is any of that activity useful? Well, to quote Lord Turner in the UK, the chair of the Financial Services Authority, a great deal of what the financial sector does is anti-social and of no real benefit to society. Well, I'll put a blunt summary on this. The vast majority of the activity in international financial centres or secrecy jurisdictions or tax havens, call them what you will, is antisocial activity. And those who promote and undertake that activity on behalf of clients so that they can hide their transactions from view, not pay their taxes where they are due, and generally undermine the effectiveness of the taxation systems of the elected governments of the world, are thoroughly antisocial and anti-democratic themselves. This report is a disgrace. Those who promoted it are promoting anti-democratic activity, And I sincerely hope that most people understand that this is the case. And economists who promote these ideas are misguided in their actions. Thank you for listening.